Well, ladies and gentlemen, MPW, I know, another MPW video. They've had a 12% plus rally here in the last few days. Now, this is largely because of a new shareholder presentation and update they released for June of 2023. In this presentation, they go over a lot of the different points that I've honestly been covering on their valuation for quite some time. Basically spelling out in pretty graphs and images why their stock is actually undervalued and, potentially worth taking a closer look at. So I'm glad that they did this because, frankly, it's been staring us in the face if we just looked at the financials all along, but some people need it broken down in charts, graphs, and in a pretty PowerPoint presentation before they'll get the picture, okay? So, right here on this slide is probably the best summary of my primary argument for this stock, okay? Because I've always said, no matter how you slice it and dice it, whether you value them based on funds from operations or on their assets, they are still at a substantial discount compared to other REITs, okay? And these are the accepted valuation metrics: multiples of funds from operations or net asset value. And they also, threw in the yield, which I don't really necessarily believe that using the yield for valuation, but it does make a pretty good point because yield and price are inversely correlated. So when you look at their, NFFO and AFFO, these are just both different ways of, slightly different ways of measuring funds from operations. On NFFO, the peer valuation, the normal multiple for other REITs that they view as peers in a similar area of the market, almost 14x, whereas their current, as of a few days ago before this rally, 5.3x. Okay. Their own historical average, 11.6x. Either way, this is actually over a 50% discount in terms of this multiple. And that was at the point where they were in like the low 8s, like 8.20 or something per share. Now, adjusted funds from operations, similar kind of discrepancy. Their normal valuation for a peer is 16.5 times. Their current 6.6 times, and their own historical average 13.5 times. So it seems like for MPW, it's normal for them to be maybe, in terms of FFO multiples, at a slight discount to peers. But even compared to their own historicals, they're at like a steep discount to their own previous averages. Now, with yield, which is, inversely correlated with cost, if they keep paying the same dividend per share, their peers are averaging 5.8% yield. Their own historical average is a 6.3% yield, with their own current yield having been 4.1 or 14.1%. So the reason the yield has been so high isn't because they have some kind of unsustainable yield trap dividend. It's because their multiple of funds from operations has been pushed so low because the share price has been pushed so low. Now, my favorite metric to point out with this is the discount to net asset value, which has been a negative 41% compared to negative 3% for their peers, which means the peers are trading relatively close to their net asset value, and they're trading at more than a 40% discount to their net asset value. That's the balance sheet. And I think that's probably, one of the cleaner measures, just because funds from operations, depending on, especially for adjusted funds from operations, how they adjust it can be, potentially, you could see some manipulation there, but it's hard to really manipulate the exact breakdown of the assets that they possess on their balance sheet, and because all their assets, their cash, their debt, it's all accounted for on there. And their own historical average, actually, on this metric is usually a 17% premium versus a 41% discount. So once again, compared to their own historicals, that's more than like a 50% discount off their own historical averages. So any way you slice it, MPW has been at what would seem to be a discount when you purely look at standard valuation metrics, no matter which ones you look at. Now, they haven't really changed anything about their overall general strategy. They invest in hospitals, which are real assets. They're essential. They point out that if a tenant cannot pay, a new tenant is found. And that, just a general thing, rent expense is a small portion of the tenant's net revenues. So that means that the tenants that they have a lot of costs that are a lot more than just rent to operate. And so rent may not be the thing that they're struggling to pay, even if they are struggling in a number of areas. And that, may or may not, bear out, like with Prospect, they definitely had some trouble with the rent, but it seems like that ship is being righted. As I mentioned, rent payments would resume partially in September, with full expected to resume in March of next year. Now, they have some projections based on what they will do in terms of cash income under different inflation conditions. So they have inflation-based rent escalators based on the CPI. So if the CPI comes out higher, they can raise their rent by a higher amount for that year. Now, a lot of other REITs, like Realty Income, for example, have something like a 1% rent escalator. But some others that I like a little bit better, like Vici, have CPI-based rent escalators, or are in the process of implementing CPI-based escalators. And that's what MPW has, that, I believe, in all or the majority of their properties. So the black bar represents high inflation. And as you can see, the further time goes on, the better they would do if inflation was higher in terms of cash income in excess of interest and dividends. So this graph basically measures how much cash they will bring in over and above the interest they expect to pay on their debt. And this is assuming that they would be doing refinancing with long-term fixed rate debt on all of the debt that they have. No acquisitions, etc. So they're just assuming it's like with what they have right now. And they're also assuming that they would not recover any of the Prospect-related collateral outside of the Connecticut property sales that are ongoing. So basically that means like, hey, what Prospect hasn't paid us, the amount that they were behind or whatever, they're basically assuming they would get none of that back in these projections as well. So relatively conservative assumptions. And basically you could almost consider this to be like a margin of safety on the dividend, because this is how much cash they expect to bring in above the interest on their debt and the dividends that they expect to be paying out over the next basically 10 fiscal years. So the fact that all of these low, moderate, and high inflation projections are above, the bottom zero line here basically means they expect to be able to bring in more cash than they're paying out in interest and dividends, which would signify that they're trying to signal basically the dividend is probably not going to be cut. I think that's the signal they're trying to send with this infographic here. So basically, to conclude, all the things that I've been trying to point out about the merits of MPW, their low valuation compared to normal metrics for their own historicals and for peers, plus the fact that they benefit income-wise from CPI-based rent escalations, mean this is a potentially really interesting investment. I got my first 100 shares of this company last fall. I think I made my first video on them in March. And in the time between last fall and now, my position has increased tenfold. So I have a lot of conviction that the financials and the bottom line speak the loudest, and that a lot of this negative publicity, short selling research and whatnot is basically just meant to drive down share price for the profit of short sellers, which is why MPW also engaged in that defamation suit against the so-called research that was done on them and published and drove down their share price. So that's the update on MPW. If you want more updates on this and other stocks I cover, as well as discussion of other financial matters, please subscribe to the channel, hop on to my Discord, link will be in the description, and give me a follow on other platforms like Twitch. I will link that in the description as well. It helps support the growth of our community that discusses all things money, finance, investing, etc. Take it easy, have a wonderful day, and happy hunting.